Nigeria's mid-year economic review paints a mixed picture. GDP rebasing boosted growth to 3.13% in the first quarter of the year, while inflation eased to 21.9% in July, aided by FX stability. Yet, rising debt, fragile security in some parts, and consumers straying from high costs remain pressing challenges. Analysts say fiscal reforms, disciplined monetary policy, and investment in productivity will define the outlook for this half of the year. Olusegun Zaccheus, partner and chief economist and lead strategy for West Africa at PwC, joins me now to discuss this report further. Great to see you.
Hi, Rolake.
Hi. So, how sustainable is the sector-driven growth? We've seen GDP rebasing lifting growth to 3.13%. Finance, ICT, construction, real estate are all huge drivers. How sustainable is that type of growth?
Thanks. And I'm happy to be here having this conversation with you. I think if you look at the numbers, right, economy really don't grow in absolute. It grows driven by sectors that are very attractive, right? If you look at those sectors you mentioned, and you look at some of the development in those sectors, for example, if you look at finance, right, and you talk about the capital raise being done by banks, and the question you ask yourself is that, how will this capital be deployed? They'll be deployed, and when they're deployed, they create growth. So certainly we expect growth from that sector of the economy, and we expect it to continue to drive growth. If you look at ICT, activities are picking up again, AI, digitization, etc., fiber, etc., all those activities that we see. We also see economic activity sort of increasing in that sector of the economy. So if you take all these sectors together, they will continue to drive growth, right? And that's what we'll see developing over the next few months.
And my observation here is that this sector-led growth, it's focused on key sectors. I'm concerned about agriculture and manufacturing. So the narrative will end up being services heavy, jobs light. Isn't that really what we're seeing there? If I'm looking at it from an economist perspective, how can we get agriculture and manufacturing to actually play a bigger contribution in this sector-led growth?
That's an excellent question. I think for me, it's a question of sequence, right? If you look at, for you to drive macro stability, right, the critical factors that is, in that scope that limits your ability to fund manufacturing. Because if you want to drive macro stability, interest rates are high. If interest rates are high, it means manufacturing will find it difficult, right? So all you need to think about, how should we sequence this? You need to, first of all, create stability and work with sectors that can give the short-term burst of growth. Right? Then in the medium term, you focus on fundamental structural issues that will help both agriculture and manufacturing. Because if you look at those sectors, what you need to do are structural, which means you need to bring down the cost of production. You need to bring down the cost of funding, right? You need to strengthen the value chain. All these things don't get done in the short term. There are things you invest in, right, that you need 2, 3, 4 years before you begin to reap, right? So for me, the government should take a view, sequencing this. Let's have stability with service-led in the short term. And then while you're investing in the development that you require for both manufacturing and agriculture, that will get more of this sector growth in the medium term.
Okay, so timing a phasing issue. Let's move over to some other key indicators. Now, debt service to GDP eased, but the debt service to revenue actually increased. It seems like a bit of a mismatch here, and I'm trying to understand the issues here. How concerning is this in your mind for Nigeria's fiscal sustainability?
Yeah, I think theoretically, fiscal sustainability in terms of debt to GDP is an issue to reflect on, right? But you need to weigh this, right? What do you want to achieve? If you are able to borrow to fund growth, right, invariably your GDP grow faster.
But it seems like we're borrowing more for survival.
Yeah, so if you look at what is happening, maybe that's a bit of stuff you need to fix, right? There's been some conversation around borrowing for infrastructure growth, right? And we know about the road, the railroad, etc. and all that, right? I think that's on one hand. And I think on the second, and what you need to think about is if you then begin to achieve that growth, because you need to achieve growth, right? And the other thing we need to think about is that if you don't borrow, will austerity help your economy grow? It will create a worse situation. It will create social, issues, etc. and all that. So it's a delicate balance, and then I must encourage the government to continue to put eye on those data. But if you then look at some of the things we're having around the tax reform, right? If fiscal revenue increases, right, it also helps both with debt servicing and future revenue growth, right? So pulling all this together, it's delicate, but I will certainly not say we shouldn't borrow. I'll say, how do we allocate those borrowing to fund future growth? I think that's what we need to think about deeply.
Good point, and certainly make it less consumption heavy. Okay, you mentioned tax. So we saw the 4 tax acts that were passed in June 2025, effective January next year. Many people agree that this is a fantastic policy, long overdue. My concern is enforcement capacity in Nigeria. And so how do you see this really impacting some of our fundamentals in ensuring that the tax acts actually achieve the outcomes that they've been set to achieve? Because we can have a strong tax structure, but you could still end up being cash poor because enforcement isn't great. So can you talk to that a bit?
So that's interesting. So when I look at the tax acts, there are 3 big things you reflect on in terms of the impact. One, it will certainly result in increased tax revenue, right? Because a number of new taxes have been introduced that will generate more money for government. So that's on a positive. What the tax law also tried to do is to remove what you call the friction, right, from the government perspective in terms of tax collection by creating National Revenue Services, etc. and all that. Reduction in that friction will also, at the end of the day, help the overall efficiency. And the third point we should pay attention to is the adoption of technology, right? The e-invoicing and a couple of other technology platforms. We expect this to also ease and also help execution. And if you look at what has been happening, a lot of different companies are already putting in the platform to drive this, right? So I think if you take a combination of those 3 things, right, execution will be a lot better, and because technology is available, and then there's a center point of coordination.
Absolutely.
Yeah, which will also help it, also help the execution.
Yeah.
So I expect a bit more positive from this. Obviously, there will be a lot of torturing steps that we need to take, but this is all in all a lot more positive.
I mean, I definitely like the infusion of the digital and technology aspects because I think that's really going to help with the implementation. But we'll see how that goes. Let's look at another indicator, inflation. Inflation has eased to 21.9%. But month-on-month inflation actually rose. So can you tell us what is going on here? What's the...
Yeah, so I'll tell you two answers I'll give you. The way I think for an economy like ours, how you should look at inflation, right? We need to be a bit more midterm, right? And focus less on month-to-month, right? Because what you want to do is that you want to be like other African countries. You want to be at a single digit. I think our measuring stick should focus on how do we get to move from where we are now in twins and to go into teens and then move into single digit. So in terms of month-to-month, it will just fluctuate. Maybe if there's production issue, if there's FX increase, jacking up and all that. But if we then focus on the trend, are we likely to trend down below 20%, maybe more likely. And I think that's what we need to focus on, because especially for the investors, you want to see, look, what's the direction of inflation? How does that affect FX in the near future? And how does that affect your ability to bring funding and your real returns, right? Those are the focus. So I think all in all, and despite the month-to-month fluctuation we'll have with FX season, it will change. If there's a quick shock on FX, it may change. But let's just look at the trend. And the trend is really, despite going down.
Do you want to be called out on a forecast? Do you do any inflation?
No. So what we try to do is to give a directional instinct, and with all intent, right? It's going to
trend down. But there's one thing I wanted to ask you about: the base year effect of this easing of inflation. How much of it is really actually real? Because I think the issue has always been the sticky structural inflation, right? The stuff around infrastructure, insecurity, and all of that. And so the concern, even as you see this trend of easing inflation, is that this emerging macroeconomic stability could potentially mask continued distress at household level, where actually for those really at the bottom of the pyramid, the effects are not really trickling down that much. So how does that even align with the issue of structural inflation, the one that's linked to the factors that monetary policy cannot tackle?
I like your question, and this is what people need to understand. And look, there's macro stability.
Yes.
There's transmission to consumption.
Okay.
There are different things, right?
Right.
So where we are now is the point of macro stability, right? What macro stability does is to
create the environment that would
for
allow
capital to come in, and capital creates jobs, creates income creates consumption, right?
Yeah.
So to get to the point of easing at the household level, we're still like two years out.
Okay, 2 years out.
We're still like 2 years
out,
right?
2 years out will be at elections.
Yeah, so and that's why when you're going through a process like this, right, you need to create some sort of intervention fund to help ease, because that's the only thing you can do now for government to ease at most vulnerable household level, right? But for me, if we continue on this trend, right, we get stability. So it's sequence. Stability, capital comes in, capital creates jobs, jobs creates income. And we then get to a point in which we begin to talk a bit more about prosperity of the people, economic development, etc.
Okay.
So, but certainly we're in the right direction. And then we circle back to your point around inflation. So there are two ways, and I'm sure you know this, to look at inflation, right? The guys that talk about cost push and structural inflation will always say it's always transitory, right?
Yes.
That at the end of the day, excess money supply is the main cause of inflation. And if you look at the issue of Nigeria, we have money supply issue.
Yes.
Right? And as the money is being paid to the state government, it creates money surplus. And invariably, that's a pressure. That's why interest rates will continue to be relatively high, because for me, I believe CBN will continue to manage that excessive pressure, right? So all in all, inflation will go down. Household will continue to wriggle through for the next 1 to 2 years. And if everything goes as planned, right, in 2 years plus, we'll be at a better place at household level as a country. Okay,
fantastic. So we also see that the CBN injected $4.1 billion into the FX market in the first half of the year. MPR, of course, kept at 27.5. Most people argue that that's been really effective in stabilizing the naira alongside all the other policies. Where do you sit on this? All of what we're seeing now, is it a managed calm? Sometimes people say there's a calm before another storm, or have we finally got it right?
Very interesting question. So, I
think very briefly, because we're hearing
all of us need to understand this. When there's a shock that you cannot manage, everything will sort of break off, right? But where we are, I think we're in a managed band in which if there's no excessive shock, like oil price moving to like 20, 30, 40, right, and dollar per barrel, we are getting to a point of stability. And you can see some of the, given the confidence that we can now spend our naira card abroad, etc. and all that. I think there's a sufficient, liquidity in the FX that will sort of support us over a couple of months. So I think we're in a better place, and that would be my
fantastic.
My point of view.
You make an interesting point, because there's also a confidence boost to consumers, in a sense. If you get the sense that finally we're in stability, then you start to make choices and decisions. You don't feel as desperate.
Yes.
Especially on the FX front. I think there's a bit of a psychological aspect
and also
to that.
for local investors. So like I'm also a consultant, right? We're seeing a lot more people venturing because they have that sense of stability.
Yeah, indeed. An outlook for the rest of the year, where will we land on some of the key indicators, growth, inflation, rates?
So I think for growth, for me, anything less than 5-6% will just be
on average for the year.
Yeah, that's anything less than 5-6%. So we'll be around 3-4 in the middle-ish, which at the end of the day is not where we want to be, right? So we'll continue to model through 3.5 to 4% GDP. Inflation will be in the less than 20s, hopefully, right? FX will continue to be stable, at least for the next 4 or 5 months.
Thank you very much for your insights. Great to have you so much. Thank you.